and some strategies that'll help you potentially save yourself a good bit of money in retirement. And if you're not quite there in retirement, even better, this will help you kind of get some planning down now. I can't think of a better time to really start looking into tax planning for retirement income. Right now, where we are, we're at historically low tax rates. These tax rates are in effect until 2026, at which point the tax code reverts to where it was before the current tax cut. Not only that, but what's been going on in the world recently, our government has spent more than 4 times what they spent in 2008 to try to bail out the economy and keep everything going smoothly. We've got extremely high levels of obligations for Social Security, for Medicare, on top of all the money that's being spent right now. At some point in time, that money will have to get paid back. And I don't know if you believe like I do, but I think the tax rates that are in effect right now are probably the lowest that I'm going to see in my lifetime. I'm expecting tax rates to continue to rise no matter what party is in office. I might advise you right now to go grab a pen and a piece of paper. If you have a few moments, quickly grab one. You might want to write down some thoughts or some ideas that you have or something that piques your interest during tonight's class. Also, we'll be doing some relatively simple calculations, but you might want to follow along. You might want to do these calculations for yourself to kind of check them out as far as your own situation. This class tonight, this webinar is really the first part of the class. Everyone who's here tonight will get a call or an email to see if you want to take part in the second part of the class. This isn't really too much of an interactive demonstration tonight. It's more of a presentation for you. The second part of the class is really meant as a one-on-one to help answer each of your questions about your own situation. So I advise you to take us up on that. Basically what you're going to see across the screen a few times tonight, I'm going to do it right now, is a little offer. If you want to just email me to say, hey, Keith, I'd really like to set up a time to talk to you one-on-one, but you'll also get a phone call as well. So expect a call after the presentation tonight from either myself or my assistant, Jackie. If you don't want to answer the phone, you don't have to answer the phone. But we just wanted to offer everyone that one-on-one to really help you with your own situation. So without further ado, we're going to get started here. I'm going to read this real quick, and then I'm going to try to slow things down. I'm not going to try to keep you here for about 45 minutes or so. I know it's dinner time. Many of you are hungry, or maybe you're having a snack right now, but I'm not going to take up your whole night. But I do want to get a lot of this important information out to you. Presenter is in no way employed, affiliated, or endorsed by the IRS, Social Security Administration, or any government agency. Presentation not intended is not should be construed as tax advice. Please consult with an enrolled agent, CPA, or attorney before implementing any of these strategies discussed. All examples are hypothetical and for illustrative purposes only. Actual results will vary. No part of this presentation is intended to make an offer of sale, purchase, or of any particular product. I'm an investment advisor. We have a tax practice in our office, so that's why I speak on what I see all the time, and a lot of the mistakes that some clients have made in the past, and mistakes that I don't want anyone watching tonight to potentially make. My goals tonight, I want you to basically understand what that Tax Cut and Jobs Act was that was passed back in 2017, how that changed the tax layout from back then till now, and then going forward into the future. I want you to understand how that affects your retirement income streams and why it's so important right now to take advantage of these low tax brackets that are temporarily in place. Like I said, I'm expecting taxes to continue to go higher. At some point, we have to pay back this $3 trillion plus that's just been printed out of thin air to kind of stabilize our economy. We're going to identify some tools for you. Basically, what we're going to talk about tonight is focused on middle income earners and retirement earners. Basically, that's the majority of my bread and butter, the majority of what people that I deal with, and for the average American, where they fall in. The majority of our clients and the majority of Americans are in that middle class, and so that's where we're going to stick to. I'm definitely not going to talk about politics tonight at all. I'm not touching that with the 10-foot pole by any means, but I want to stick to where we are today, how that tax cut affects you, and where we might be potentially in the future. I want you to kind of look out, because every year that clock ticks over to the next year, we've lost an opportunity if we haven't taken full advantage of it. Every time we file a tax return, every time that calendar year ends, we've lost an opportunity. Whether we took advantage of it or not is so important right now. If this is what you and your wife or you and your husband maybe look like when you're kind of trying to read a tax code or do your tax return, if you even do it yourself, you're definitely not alone. It's not really meant to be intuitive. In fact, I would argue the tax code is extremely counterintuitive. One of my beliefs on why that might be is that there's so many different tax laws out there that, you know, any politician who comes into office can basically say that they cut taxes and not be lying, because when you have thousands of different taxes in the tax code, you know, even if you cut 2 or 3 of them, you could say that you cut taxes honestly with a straight face. So just like Social Security, just like maybe Medicare, a lot of government programs are not so simple and easy to just decipher. They make it complicated, and the tax code is definitely one of those items. So if you're confused, don't feel like you're alone. You're definitely not. I'm going to start kind of real basic. You know, this, and like I said, tonight we're going to be sticking with that married filing jointly tax bracket. And for tonight's intents and purposes, I'm going to be talking about people over the age of 65. So a married couple over the age of 65. So here's that married filing joint tax bracket. Looks pretty simple, right? Relatively intuitive, very simple and straightforward. If your taxable income is between $0 and $19,750, all the dollars that fall into that tax bracket are taxed at 10%. Once you get $1 over that $19,750, that next dollar is now taxed at 12%. Same thing with the next level up. If you make $8,300, well, you've got $50 that are taxed at 22%. So that looks very simple, straightforward concept. Here's what that exact same principle might look like if you've ever done your own paper return. If you've ever actually filed your own taxes, it's presented in just a different way so that you can kind of understand and see how it is. And all this is showing those exact same tax brackets. The difference is that once you get to that second tier, it's showing you up until that point what taxes you would have already owed. So you can see on that second level, it's showing you on the right-hand side that you would owe, if you've cleared the 10% tax bracket, we know that you owe $1,975 in federal taxes, plus 12% of any amount over that until we get up to $80,250. And then the very next bracket says the same thing. If you made $80,251 worth of taxable income, you would owe $9,235. Any dollar over that amount would be taxed at 22%. So again, relatively simple concept, just a different way to look at things to help you understand it. Everybody learns in different ways. Everyone understands things in different ways. And I've got one more slide to kind of show you as well. This is what's called a tax map. Very exact same similar data, exact similar concept. The only difference with this is that you might notice is there's a little, in the lower left-hand corner, it's showing up to almost $30,000 at that 0% tax rate where there's no taxes on it. And the reason for that is simple. This tax map is including if you were in that married filing joint over 65 tax situation. You'd get that standard deduction of $24,800, plus since you're over 65, you get an additional $1,300 each as an addition to the standard deduction. So if you're married filing jointly and you're both over 65, your first $27,400 is basically taxed at 0%. So you'll notice it bumps up from 0 to 10. That's kind of a significant bump, 0 taxes to 10%. Then we see a small bump to 12%. And then you see another big bump from 12 to 22. And then further to the right, you'll see another bump from 24 to 32. These are those big jumps in the tax brackets. And this is where a majority of the planning of most people really comes into play, is you really want to take advantage of those full dollars of those lower tax brackets. Like that 12% bracket, you want to be taking full advantage of that right now, because like I said, it's gone in a few years, and that 12% bracket will then be 15. So it's kind of a good time to maybe diffuse some of your IRA if you can, depending on your situation, because I know that I'd much rather pay 12% on my withdrawals than 15%. Now, granted, we're in a very unique situation right now with where the economy is and what the stock market's been doing. But these are all things that you need to kind of look at and consider. So basically what we just kind of discussed was, marginal tax rates, the tax rate that your last dollar of income fell into and how it's taxed. That was ordinary income that we just kind of discussed, those brackets. The government really wants to incentivize all of us to invest our money, not just in the stock market, maybe in real estate, maybe in businesses. You're going to see more more of that coming out over the next few years. They're really going to want us to continually to invest in America and invest in growth for our country. We've obviously set a huge kind of a setback that we're going through right now. So right now, capital gains and qualified dividends get a little bit of a different treatment. They basically get a preferred tax rate to promote those things. So there's the concept is very similar to ordinary income. Only the amount above different thresholds is taxed at the higher rate. Prior to that Tax Cut Act of 2017, they were linked directly to the ordinary income tax brackets, but now they're slightly askew, slightly different. And I'm going to show you the tax map of that just right now. So for right now, if your capital gains or dividend income was the only income you had, and you were married filing jointly over 65, you could make up to $107,400 tax-free. How is that, Keith? You're showing me right now the bracket's only up to $80,000. Again, I'm adding on the standard deduction to the top of that. Most people, when I ask them about capital gains, they say, oh yeah, long-term capital gains are taxed at 15%. Well, that's true for the majority of people, but for some people, they're taxed at 0%. If you're a high net worth person with high income, they can be taxed as high as 20%. This is only for long-term capital gains and qualified dividends. Short-term capital gains, which would be a capital gain that you incurred with the purchase or sale of something less than 12 months, are taxed at your ordinary income rate. So there's a little bit of a difference there. This is just that same exact tax map format of looking at capital gains. And if you look, you see that 0% rate. And it's showing that including that standard deduction for married filing jointly over 65. So what this kind of, how you might use this, or how some of my clients have used this is, you know, in retirement is so important. Retirement is one of the few times in your life where you have absolute control over your income. You get to decide when to turn on a pension if you have one. You get to decide when you turn on your Social Security. That's up to you. And you also get to choose when you take out money from your 401k, your IRA, up to a certain point. And we'll get into a little bit later. But you're in the most control you've probably had in your life of being able to control your income. Well, having those controls also really lets you play with the tax code and really take it to your advantage. The whole thing is really just kind of a puzzle that you need to piece together so that you're paying the least amount of taxes as possible and doing things as efficiently as possible. I want to go through deductions, exemptions, and credits just so you understand how they work and how they affect your taxes as well. Each of these items affect things very differently. Deductions, basically what they do is they reduce your taxable income level of what it's taxed at. So if you and your wife or you and your husband made $100,000 and had $100,000 of taxable income, you'd have to then decide if you're going to take the standard deduction, which is what the majority of Americans do now because the standard deduction was raised so dramatically in this Tax Cut Act. Back in 2017, the married filing joint standard deduction was just $13,000, and currently for 2020, it's $24,800. They did that to simplify the tax code and to make it so that it was less hassle for most people. So really, the majority of Americans no longer do an itemized schedule when they're doing their taxes. Some people do, and depending on your circumstances, you might want to, especially if you're charitably inclined or have other specific situations. In our office, we always compare side by side what makes the most sense, either taking the standard deduction or itemizing, and we'll go through all the processes of what makes the most sense for you. But tax planning has to be done before the year ends. You can't go back and look and have your CPA or your accountant look at it when you give them all the paperwork, and, today and say, hey, can you do my taxes? They can only tell you, they're kind of like a coroner. They're telling you what happened. Okay, this is what happened. This is where you are today. And they could have told you what could have been done, but they can't tell you what you can still do right now for last year. You've got to be planning in that current year of where you're drawing your income from in order to really kind of get yourself as organized as possible and take advantage of the tax code. Because once it gets to the next year, there's very little you can do. You could still contribute to a health savings account or to a traditional IRA up until April 15th this year, July 15th, because of what's going on. But once the calendar year closes, there's not too much else you can do other than contribute to that traditional IRA or HSA to lower your taxable income. But like I said, right now that standard deduction has jumped from 13 to 24.8 for married filing jointly. Basically, if you're itemizing, you can deduct mortgage interest up to debt of $750,000, not including home equity lines of credit. You used to be able to take out a home equity line, buy a car with it, and write that interest off on your tax return. You can't do that anymore. They changed the lines. Now it's very specific what you could potentially write off with a HELOC. It would have to be home improvements and things like that on the home. But there's very specific rules on that you'd want to check before you just took out a home equity line to do a repair on the home. Charitable gifts of cash or check, you can basically write that off up to 60% of your income. You could donate appreciated assets like stocks. Some people will donate stocks because that way they don't have to pay the capital gains on it, and they also get a tax deduction. That's only up to 35% of your income. And then you can deduct what's called the SALT tax, state and local property taxes, up to $10,000 a year. Again, I've already mentioned the additional standard deduction if you're over 65 plus or blind, which is that extra $1,300 per person. Exemptions are gone. They eliminated the personal exemptions. That's part of their reasoning of doubling the standard deduction. They're basically dropping out those personal exemptions because they've doubled that standard deduction. For some people, it worked out for the better. People with less kids, people who have a bunch of kids, it didn't work out so well for. But that's now gone. Credits. Credits work differently and are far more valuable than a deduction. What a deduction does, it just lowers your taxable income. So if your income was $100,000, you had a $2,000 deduction, that would then lower your taxable income from $100,000 to $98,000, and then the tax would be calculated. Credits are far more valuable than deductions because a credit comes dollar for dollar off the actual taxes that you owe to the government. So if you owe the government $3,000 in taxes and you had a $3,000 credit, you would then owe the government zero. A credit, again, is far more valuable than a deduction. Here's some of the common credits that are still available today that people are probably taking advantage of or should be taking advantage of. Some of these are lesser known, specifically for people who maybe decided to work part-time in retirement. That Savers credit is a huge benefit. And if you're not retired yet, you can maybe kind of figure out a way to plan to get your income where you could qualify for that. That's the whole thing with tax planning, is looking forward and trying to take advantage of things. Right now, there's that healthcare tax credit where if you buy your health insurance, through the state exchange that was, created through the Affordable Care Act, the healthcare tax credit is basically a calculation on the number of people in your family, your income, and the state that you're in. So that's all calculated in, so you could potentially get a credit on what you have to pay for health insurance. That's only if you get your health insurance through the state exchange. There's an earned income tax credit. That, again, is based on your taxable income and the number of people in your household. And what that basically does is it provides income tax credits for lower earners. So that's only available to lower wage earners, middle to low wage earners. There are currently education credits. So if you've got children in college or going to college, there's a couple different tax credits that you could potentially take advantage of. And you need to take a look at which one makes the most sense for your situation. There's the American Opportunity Tax Credit. That's up to $2,500 in tax credit per eligible student in your household. And then there's a Lifetime Learners Credit, which is basically just up to $2,000 per return. So you kind of have to look at them both and figure out which one you're eligible for. And it also, like I said, depends on your income level and how many kids you have going into college. The Savers credit I already kind of touched on, and we're going to do a quick example in a minute here of what that Savers credit could potentially do for you. But that's a huge benefit if you can plan accordingly, or if you fall within that threshold of where the numbers fall. It's a huge credit that I don't think most people realize is available. And then the child tax credit, that's still available. That's basically $2,000 per child on your tax return under the age of 17 that's your dependent. It phases out with married filing joint couples over 400,000. So the majority of Americans still do get that child tax credit. But again, credits are far more valuable than deductions. Just I want you to remember that. This is an example of that Savers credit. And this is something that people in retirement might consider trying to work their income to getting it to fall into this level. Whether or not you've turned on your Social Security or not, it doesn't matter, but it's all about your total income levels. So if you just take a look at this, I'm going to flow through this with you so that you understand it. This is for a married filing joint couple over the age of 65 that had a gross income of about $38,000. That was their taxable income before they started taking deductions. So they happen to fall into that standard deduction category because their itemizations, it didn't make sense. And for most people, it doesn't make sense anymore. Now, the one caveat of this example is they needed to have earned income because this couple is actually going to contribute to a traditional IRA. So they basically took the standard deduction. They're over 65, so they get that deduction of the $24,800 plus $1,300 each. So we take the $38,000 of their total income, we subtract out that standard deduction of the $27,400. That gives us to the next line where they're doing a $2,000 traditional IRA contribution. Traditional IRA contributions, if that's the only retirement plan you're offered, and depending on your income level, you're going to get a deduction, just like the majority of Americans will get a deduction on their IRA, depending on their income level. So if you contribute to a traditional IRA, dollar for dollar, what you contribute, you're going to get a deduction on that. So that's going to further lower their taxable income. So we're basically taking that $38,000 and subtracting $27,400 and $2,000, which brings us down to their actual taxable income. So their income that's going to get taxed is only $8,600 at this point. Well, that keeps them in that 10% tax bracket. So the only tax obligation they're going to owe the federal government is $860. Not too bad of a place to be in. But because they qualify for that savers credit, they get a $1,000 tax credit. That $1,000 tax credit totally covers their $860 tax obligation. So they end up owing the federal government zero. Now, if you're paying attention to things, you might say, hey, wait a second, Keith. They only owed $860, and you told me there's a $1,000 tax credit. Why don't they get $140 back? That doesn't make sense. Well, that's the thing with tax credits. Some of them are refundable. Some of them are non-refundable. A non-refundable credit means it can only go up to the amount your tax obligation, that you won't get a check for the difference back to you. A refundable tax credit, which there are certain types of credits out there that are refundable, you would actually get, the government would then cut you that check for $140. But because this saver tax credit is non-refundable, I would argue this couple to, contribute, a little bit, make a little bit more money or contribute a little bit more to their IRA so they can take full advantage of that. Maybe pull some money out of a different IRA or potentially, work a few more hours so they can take full advantage of getting that dollar for dollar of that tax credit. But that's just an example. And a lot of my clients who, work part-time in retirement and are doing tax planning, they take full advantage of this because obviously, yeah, you want the deduction, but more than the deduction is the credit. The credit is far more valuable. So I just wanted to go back to that middle income tax bracket. This is that tax map again, where you're seeing zero taxes on that standard deduction on their first $27,400 before we go up. This is just kind of a reminder of how that map works. It's going to kind of segue into what we've been doing. All the stuff we've kind of looked at, these maps, these brackets, they look pretty simple. If it were that simple, then there wouldn't be accountants in the world, or there wouldn't be people helping others with the tax system. It's not that simple because every little thing we do affects something else, and more so in retirement. You've got more going on. You might think you've got less going on. Maybe your kids are out of the house. Maybe you're not working as much anymore. So maybe your life is simpler, but your whole tax equation definitely got more complicated. Not only is it more in your control, but you've got more going on in several different ways. You're going to start running into having to take out required minimum distributions. You've got capital gains that you might start harvesting from things that you've saved outside of your IRAs, or maybe you had a second home or a summer cottage or something like that you sell. You've got Social Security benefits, which come into the mix. We've got Medicare premiums. You've got potential. Right now is a great time to do them. Roth conversions. Not only are tax rates low, But your IRA assets, probably some of them have taken a little bit of punishment recently and might continue to take some punishment over the next 3, 6 months, 2 years. We don't really know yet. Neither do people in the market. They don't really know how all this is going to play out, how quickly the U.S. economy is going to come back, how quickly jobs are going to return. So, I don't expect this, what they call a dead cat bounce of the stock market. It'll be very interesting if it actually holds, because we're going to start seeing potential bankruptcies. We've already seen companies, oil companies, like Whiting Petroleum out in Colorado. We've seen J.Crew, the clothing company, starting to declare bankruptcies. The more bankruptcies we see, the less jobs are going to come back. That means that debt is just erased and dissolved, and that is not a good thing long-term for our economy. So there's a lot going on right now, and I can't think of a better time to be really doing planning. 6 months ago would have been even better, but now is a very good time as well. We've had a significant bounce in the market, and we don't know if it's going to hold. So like I said, it's a great time to do Roth conversions because the value of your assets is probably lower, but longer term, we always, the American dream and the American hope is the market has always been higher 15, 20 years down the road than it is today. So that's the hope. So why wouldn't you want to convert it and pay taxes on a lower amount while the tax rate is lower, so that when you can take it out later, when tax rates we already know are going to be higher, that money could come out tax-free. There's so much planning right now that's going on with this that you need to be taking full advantage of is during these lower tax rates. We're going to talk about the net investment income tax. That only really hits high earners or high income people, but I want to go through that. A couple of things that were eliminated, and then we're going to briefly jump over the AMT, the alternative minimum tax. RMDs, required minimum distributions. We recently had a change. December 31st, 2019 is when they took place. The Secure Act was passed last December. So it used to be you had to take the funds out the year you turned 70 and a half, or up to April of the following year. That age has now been changed to 72. So that helps you. And the other thing that right now, a huge thing, if any of you are of that age and already over 70 and a half, or already hit the age of 72 and already taken RMDs, calendar year 2020, none of you have to take RMDs. Nobody does. The CARES Act came through, and because of what's going on in the economy and the stock market, this was just passed through Congress. The CARES Act, you do not have to take RMDs in 2020. So a lot of people out there who don't need their RMDs, who have been taking it year in, year out because they've had to, you don't have to take it this year. So if you don't need the income, so a lot of people have their RMDs set up automatically, but that's not something that's just going to automatically stop. You'd have to call those accounts that you hold those IRA or 401k assets in to stop the automatic RMDs, or at least to call them and tell them you do not want your RMD for 2020. So that's a very big opportunity if you're already taking RMDs. The other thing out there for anyone who right now who's maybe struggling, or potentially they have kids who maybe are struggling going forward throughout the end of this calendar year, they passed a bill within that CARES Act. You're actually allowed to take up to $100,000 out of your IRA if you're younger than 59 and a half, if you've been affected by COVID-19. If you have any questions on that, like I said, you're going to want to do some homework on that or reach out to me. We'll gladly help you navigate that, but that ends at the end of this calendar year as of right now. It might be extended, but I don't know. But you're basically allowed to take up to $100,000 out and not be penalized the early withdrawal of 10%. You can either pay it back over 3 years or just not have to, or just, totally remove it, but there would be no early withdrawal penalty. Normally there is a 10% penalty, but that's gone. But back to RMDs. The way that those are basically calculated is relatively simple. Basically what you do is that the year that you turn 72, all you would do is basically you're going to have to go back to your December 31st statements of the prior year, of what your account value was in your IRAs and your 401ks, and then divide that account value by what the IRS life expectancy table tells you your life expectancy is. So we're going to flip to the next screen and I'll kind of give you a quick example of that. So obviously not this year, because I've already told you that RMDs don't have to be taken this year. But if you were turning 72 in 2021, this is how things would happen right now. If your IRA balance was $500,000, a year from now in 2021, you were turning 72, all you'd have to do is go back and look at your December 31st, 2020 account balance. And in this case, we're going to say $500,000 what the account balance was. And you're going to divide that $500,000 by your life expectancy based on this IRS table. If we go down to the table, we see the age of 72. We look over and we see 25.6. So you'd have to divide that $500,000 by 25.6. And that's how you determine what your RMD was. Now, RMDs are a little bit tricky because when you retire, you might potentially have IRAs, 403Bs, 401Ks. You can have all these different things. And you're in control of these things. So you might, what I try to help my clients do is to simplify as they go along and as they get older. I know as I've gotten older, I'm 45, my brain works a little bit differently. I can only imagine what it might be working like in 40 or 50 years. I want to get my life simpler as I move forward. I think maybe what's going on in the world right now has taught us all that maybe, simple things are more important than everything else around us. Maybe not. But to me, that's a lesson that I'm definitely taking out of this, is that simplicity and the things that are important to me are what's important, and everything else doesn't matter nearly as much. So I want to simplify for myself and for all my clients. So having said that, if you hold IRAs and 401ks and 403Bs, you're going to have to take RMDs from each of those type of accounts, your IRAs, your 401ks, your 403Bs. In retirement, you can convert all of those things into IRAs. It's called doing a rollover. If you have everything classified as IRA, you can then take your RMD from any one of those accounts to satisfy all the RMD requirements. This becomes very, very important in your strategic planning, in your overall financial plan of what you're drawing from. What you've probably learned from the turbulence of today and turbulence in any time is you don't want to be drawing on volatile assets like the stock market during turbulent times. You don't want to have to draw from your stock market money and pull an RMD out if the market's down 30%. That's the importance of planning and having like some kind of stable vehicle as well. But you can't have that stable vehicle in your IRA and then also be holding 401ks and 403Bs as well, because you're going to have to take RMDs from each of those. So that's all part of the kind of the tax planning of what you should be thinking about and doing. Capital gains. Well, we've already talked about capital gains a little bit. And, yeah, Keith, you told us it's either 0, 15%, or 20%. Well, a lot of times you might not even realize you're incurring capital gains. If you hold mutual funds, outside of any qualified accounts are IRAs, 401ks, or 403Bs, things like that. If you're holding just a brokerage account or you bought mutual funds a long time ago, you're probably getting a 1099 div or in a 1099 for your capital gains each and every year. What can happen is, like, I could have bought a mutual fund last year and then the account value of it has gone down since last year, but I could still incur a capital gain this year. And the reason for that is mutual funds aren't always the most tax efficient vehicles to hold assets in that are non-qualified. My mutual fund could have held, GE stock, or it could have held, so many examples of stocks right now that have just plummeted this year. Could have held Citigroup or, Bank of America or any of these stocks. And basically what could have happened is the mutual fund company could have bought those stocks 20 years ago. They could have bought Apple 20 years ago and decided to sell it this year. Well, the mutual fund company has to pay the capital gains. Well, they don't pay them. They pass it through to you. But the capital gains still have to be paid on that gain of Apple. They could have bought it 15 years ago and paid $8 a share, and now it's, split, and now it's worth, $300 a share. Those capital gains get passed through to you as the mutual fund holder. Even though you've only owned that mutual fund for a day or a week, those capital gains get passed through to you. So they're not always the most tax efficient vehicles to hold money in. You could be rebalancing, right? Let's say you hold 5 stocks or let's make it simple. Let's say you hold 2 stocks, right? And every year you rebalance. So let's say you held Apple and Bank of America. And every year you want to keep those at 50%. Well, right now, if you were to look at it, I'm sure that Apple would be about 80% of your portfolio and Bank of America about 20%. So at some point in this year, you'd sell off some Apple to get your holdings back at 50-50. If you're doing any kind of portfolio rebalancing on a yearly basis, you're paying capital gains every year, more than likely, on those sales that you're making. The other thing about capital gains, and this is where retirement comes so into play with things, is that long-term capital gains, no matter where you are in the spectrum of income in retirement, can basically create ordinary income tax. And this is where the tax code gets counterintuitive in retirement, where it doesn't make sense. But just like anything in your retirement plan, your Social Security, your pension, your IRAs, your 401ks, everything needs to work together smoothly to be efficient. The same thing is true with long-term capital gains and what you're taking on them. And this is the main reason for that, is Social Security. Because Social Security in itself, if Social Security was your only source of income in retirement, you wouldn't pay any federal income taxes. But for most Americans, Social Security doesn't quite cover everything they need. Deciding when and how to turn on your Social Security is a whole nother class in itself, but it very much ties into the taxability of your retirement income, and it should be for your retirement income planning. Social Security is determined if it's taxable or not. It's based on this calculation called provisional income. What provisional income is all the government's basically doing is they're going to take exactly half of your Social Security benefit. So if you're married, you and your wife, they're going to take the 50% of your total Social Security income that you receive in a calendar year. They're then going to add any ordinary income on top of that. So like your wages or, capital gains or dividends. They're also going to add non-taxable interest. So even interest you receive on municipal bonds is considered tax-free interest. That's get added too. It's almost easier to tell you what they don't add to provisional income. What they don't add to provisional income is anything you pull out of a Roth IRA or a Roth 401k, because you've already paid the taxes on that. Any non-taxable inheritance, that wouldn't be included in provisional income. And then also anything you might have maybe borrowed or pulled out of any life insurance that you have that was up to the basis of what you paid in. So any life insurance that basically has a cash value to it, anything you pulled out, took a loan against that cash value, is not considered income. You're considered basically borrowing against your own investment or your own principal. So that's not considered part of provisional income. So it's really basically just Roth and life insurance is what isn't part of that provisional income calculation. This is where, if you have that pen and paper handy, you might want to follow along if you like to do math. So these are the charts of those tax thresholds of Social Security. So these haven't changed since the early 1980s. So if you're single, up to $25,000 could be taxed. Up to 50% of your Social Security could be taxable. At $34,000 or more, up to 85% could be taxable. The same thing goes for married filing jointly. Those brackets aren't doubled like we see for the standard ordinary income tax bracket. They're just slightly above. So they don't really double it. They're not really helping us out. What the government gives, they're going to take away. All the more important for your planning in retirement. But basically anything over $32,000 can be taxed up to 50%, at $44,000 up to 85%. So we're going to take a look at how that could affect two different couples in retirement. So we're going to take two couples, both have $60,000 in retirement income. They just get it in different ways. This kind of shows you how Social Security planning, when to take Social Security, how important it is. A lot of people just think, hey, I've been working my whole life. I'm turning it on as soon as I retire. I don't care. I've been waiting for this check. I'm entitled to it. I want to get a hold of those funds. Well, you got to kind of think twice about that. Here's those two different examples. So one couple has $20,000 in Social Security income. Then they also draw $40,000 from their IRA because they need $60,000 total in income. Well, that creates a provisional income of $20,000. Remember, provisional income is half their Social Security, so half of $20,000, $10,000, plus that $40,000 IRA withdrawal. That gives you $50,000 provisional income. This is how you do the calculation of what of their Social Security income is taxable. You take the provisional income number, the $50,000. You subtract that first tier of taxability on Social Security income, which was that $32,000 level. And then you multiply the difference. You subtract 50 minus 32, you get $18,000. You then multiply that by 0.5 because we know that 50% of that is taxable. So we come up with $9,000. We then go to that second tier, which is that $44,000 level, where we said that up to 85% of it can be taxable above that level. Well, you now take the 50,000, subtract the second level of 45,000, and you get 6,000. You then multiply that times 0.35. We've already taken into account the 50 cents on the dollar of that money, but we haven't taken into account of that additional 0.35. So that's the amount above that second threshold. That gives us a total taxability of their benefit of $11,100. You're simply adding those two thresholds. So basically $11,100 of their $20,000 of Social Security is taxable, or 55%. That second couple, maybe their wages were a little bit higher, or maybe they delayed their Social Security to get the higher benefit, but their provisional income is very different. Again, you're taking half of their Social Security, so 40,000 cut in half, 20,000, plus the 20,000 IRA withdrawal. So you've got 40,000 now of provisional income. We're going to take a look at the tax implications on them. So we're going to take the 40,000 of provisional income, subtract out that first tier of that 32,000, which gives us 8,000. We multiply that times 0.5. So we know that $4,000 from that part of their Social Security is taxable. Well, they don't have anything over that second threshold of 44,000, so we're capped. Only $4,000 of their entire Social Security income was taxable, which basically ends up being 4,000 of 40,000, or 10% of their Social Security income is then taxable. So how does this look on a tax return? Well, let's take a quick look. The couple on the left is the one who maybe didn't do things as smartly. They turned on their Social Security and had a much lower benefit. So their taxable Social Security was a lot more because their provisional income was a lot higher because they drew other assets out to get that $60,000 level. Their taxable Social Security was $11,100. We then add that on to their IRA withdrawal, which is taxable. So their total taxable income was $51,100. We then subtract out that married filing jointly over 65 standard deduction, which is $27,400. So their total taxable income off of $60,000 of total income was $23,700. Well, that's not too bad. They're just into the 12% bracket, so their total federal obligation ended up being $24,049. Not too bad on $60,000 of total income. Not too bad at all. But let's look and see if they've done maybe some more strategic planning of when they took on their Social Security. That couple who delayed their Social Security and had to take out less from their IRA is far better off tax-wise because they only had $4,000 in total taxable Social Security income, only $20,000 in IRA withdrawals to get them to that same $60,000 level of income. So their total taxable income was only $24,000. Once we take out their married filing joint standard deduction, they don't have any taxable income. They owe no federal income taxes. They actually had a little bit more wiggle room and could have taken out a little bit more money from their IRA and still paid no taxes on that IRA withdrawal. I know that's the situation I want to be when I'm there at that age, because I know the tax rates are going to be even higher. So it's all about planning and getting ready for this. Again, like I said, you'll get this offer if this makes sense to you and you want to kind of figure out hey, how can I pay as little in taxes in the future? I just did that little slide out offer again. You can send me an email if you know that you want to kind of set up part 2 of this class and do a little bit of a one-on-one for you. I want to educate everybody and kind of show them what they can potentially do in their own situation in order to kind of lower what they're going to owe in taxes. Right now, this is the lowest tax obligations we're going to have right now. I know it's a tough time right now, but that's the whole part of having a plan. My clients right now who already have plans, they're not really sweating too much of what's going on right now because they already know where their income in retirement is coming from, and we've kind of prepared for this. The other things you need to think about in retirement, if you're a high income earner, or Medicare and excess premiums. If your income combined for married filing jointly is less than 174, then you only have to pay the Part B premium, the standard Part B premium, plus the plan cost. If your income is over that level, then realistically, your Part B premium goes up. You get penalized based on your income. You'll have to pay a little bit higher in that married filing joint. This is per person. So it's roughly about $700 more per person. And you're also going to get a little additional to your plan D cost of $146.60. That net investment income that I was discussing, for married filing jointly, that's only if your income is over $250,000. So the majority of Americans don't have to worry about it. But if your income is at that level, you're going to pay the lesser of 3.8% over your income over that 250,000 level, or 3.8% of your capital gains, dividends, annuity, and rent income. It's the lesser of 3.8% on either of those two options. The phase-out exemption, that's gone with the new Tax Cut Act. So is the PEAS, named after Congressman Pease. It basically, what that did is that phased out some of your itemized deductions based on your income level. So that's now gone in the new Tax Act. The alternative minimum tax still remains. And if this affected you, you probably have already been impacted by it and know well about it. I'm not going to dive too much into this because that would be a whole nother class just to talk about this. Basically, married filing joint, if your income is over $197,000, it will kind of phase out some of your itemized deductions. Now what I want to jump into is the effective marginal tax rates. What we've been talking about is marginal tax rates, where a dollar of income in the 12% bracket, that new dollar of income will only be affected by, if you're in the 12% bracket, you think you're only going to be taxed at 12%, right? Wrong. Retirement, this is where in retirement, it totally becomes counterintuitive to what you're trying to do in retirement. If you think you're in the 12% tax bracket and the things you do in retirement are only going to affect you in your bracket level, you're highly mistaken. And this is why tax planning and everything needs to be more stringently looked at in retirement, because you've got more sources of income. You've got Social Security, you've got pension, you've got IRA, you've got potential capital gains. Again, this is that ordinary tax map to take a look at. And if you just had an ordinary income or just IRA income, this is how it would look, and it's be simple. But that's probably not the case. If you only had long-term capital gain or qualified dividend income, again, if you only had long-term gain income, you could have $107,000 of long-term gain income and pay no taxes on it. But that's probably not the case unless you've done strategic planning. You probably have IRA withdrawals, pension, or Social Security on top of it. Social Security is the real impact on all your taxes in retirement of things that you might not even realize. We're going to go through a very drastic example of that right now. And I know I'm running a little long. I promise you about 45 minutes to an hour. I'm going to try to keep it right there. But this is a real case study of a married filing joint couple, John and Jane, 65 plus. This is their income situation. They had $60,000 of combined Social Security income, $10,000 of long-term capital gains, and $52,000 in their required minimum distributions. This is what a tax map in their situation looks like. And you're going to look at that and you're going to say, this is basically the ordinary income juxtaposed over the capital gains tax map. And you're going to say, Keith, this doesn't make any sense to me. There's no 18.5% tax bracket. There's no 22.2% tax bracket. And there sure is no 49.95% tax bracket. And I'm going to tell you, you're right. There is no tax bracket at those levels, but everything works together. So your capital gains little tax chart gets stacked on top of your ordinary income tax chart, which then affects like how your Social Security is taxed. So they all works together. And this is the effect of what can happen to you. So basically that 18.5% tax bracket, that's not really an 18.5% tax bracket. What that is that their capital gains started, their income, their ordinary income and their long-term capital gains started pushing up their Social Security income to getting taxed. So for every $1,000 of income that they got added into that, you're going to start seeing 10% on ordinary income at that level. You then start seeing 85 cents on the dollar of their Social Security income becoming taxable in that 10% bracket. And that's why you're seeing 18.5. The next little tier here, 22.2, you're going to say, Keith, there's no 22.2. You're right. You're not. What you're seeing is those gains pushing up Social Security becoming taxable and ordinary income being pushed into the 12% tax bracket. So you've got the normal 12% tax bracket of income being pushed up, and you're getting 85 cents on the dollar of the 12% tax bracket, which is 10.2% being pushed up. And this 49.95 level is what I'm going to show you is next. That's when you start seeing capital gains start being taxed that weren't taxed previously because they're now over that $80,000 level. So intuitively, what happens, you're thinking, oh, I took an additional $1,000 from my IRA. I'm in the 12% tax bracket. I pay $120. Wrong. in retirement with all these different things working together, this is what happens. Yes, you do pay 12% ordinary income tax on that IRA withdrawal. But what happens in that tax map is that extra $1,000 of IRA withdrawal also then pushed up $850 of your Social Security income that previously was not taxable now to being taxable. So now that additional $1,000 IRA withdrawal caused $850 of Social Security to be taxed at 12%. What also happened was the $1,000 IRA withdrawal plus the additional $850 of now taxable Social Security income creates that baseline, which pushed up another $1,850 of their capital gains to be pushed up from being not taxable to now being taxable at that 15% level. So what that in effect did, that additional $1,000 that they took out from their IRA withdrawal, just to maybe give their kid a Christmas present or their grandchild, they end up paying almost 50% in taxes on that money. That's where the tax code becomes very confusing and not intuitive at all in retirement, because everything affects everything else. You have to efficiently plan this stuff. Otherwise, you're just shooting yourself in the foot. I don't want anyone to do that. I don't want anyone paying 50% on a $1,000 IRA withdrawal. That makes no sense. But that's how you could potentially do it. That's the situation you could be in. And you can't fix this once you've already done it. You've got to prepare for that tax year that you're actually taking these withdrawals. That's why it's so important at your age to plan. This is how it might, an additional $25,000 in capital gains could affect that same couple. Additional capital gains could pick Social Security, could kick that Social Security up into that 12% bracket, or 85 cents on the dollar. It could then kick it up to the 22% level, where they're getting 85 cents on the dollar there, and also having to pay those capital gains taxes and the Social Security tax. So between the three of them, it adds up being actually 37.2. But this is how taking withdrawals or incurring a capital gain in retirement can drastically impact you. So you have to think about those things before you do it. How can you do that? Well, you can still do it. And I've already mentioned one of the techniques. You can still do some conversions from traditional IRAs or traditional 401ks into a Roth account. And now's a great time to do it. While your assets are kind of beaten up a little bit. And we still have up until 2026 to do those Roth conversions while the tax brackets are low. Those are some things you might want to consider doing. You could look into some tax deferred products. There's products out there where, unlike your bank account, where you're getting a 1099 dividend each year and having to pay income tax on that interest income, or 1099 interest, I'm sorry, you're paying ordinary income tax on that interest. There are some products out there that you can continue to defer the taxes and not have RMDs. You need to really blend these things. So if you're all IRA, it gets a little bit more difficult. But if you haven't turned on your Social Security yet, you've got some huge opportunities to do some huge tax planning and save yourself a ton of money tax-wise goes. And I can't stress enough, we're at the lowest tax rates I think we're going to see in my lifetime. I was worried about that before the government decided to just go spend $4 trillion to prop up the economy. We might see more money released. Now I'm definitely sold on, you couldn't convince me otherwise, that tax rates could possibly be lower in the future. I just don't see that happening. And you need to decide where you are, which assets do you need to hold? You need to hold a blend of these things so you can take advantage of all these plannings. So that's something you need to jump into right now, and I'd advise you to have a plan. The first step to failure is not having a plan and just winging it, because then you're not prepared. If you're planning when it's too late, it just makes it that much harder. In my office, we're kind of bucket planners. We help people show them in their retirement how they should kind of differentiate their money. And you want to have some money now, like an emergency fund. So when things are troubling and you need a rainy day fund, you've already planned for that. You've got some safe and liquid money available. Money you might need next year or for an expected expense. Maybe one of your children is getting married in a year or two. Well, you might not want to be gambling in the stock market with money you might need in a year or two, especially where we are today. So that should be kind of conservative as well. And then maybe more risk can be taken with money you don't need for 10 years. I fully expect 10, 20 years from now that the market will be significantly higher than where it is today. But it's going to be a roller coaster ride until we get there. So you kind of want to diversify as to your risk tolerances of where you have your money so that you're set up in the future. Anyone who came to the class tonight and anyone who reaches out to me, we want to offer you kind of a free book written by the president of the company that I work for. His name is Jason Smith. This is kind of a down-to-earth planning strategy. It's called the Bucket Plan. And it kind of shows you exactly what I was just talking about with bucket planning and gives you some real-world examples. It's not written in like any foreign language like finance language. It's written in plain English, and it's really kind of easy to understand. So, anyone who comes to that second appointment with me, we're happy to, reach out to me. We'll go through a second appointment. I'll help you with anything you can, and I'll mail you out a copy of this book. My biggest pride in life is helping others. That's where I go home feeling warm and fuzzy, talking to my 5-year-old. That's where I get the pride and the joy of my job every day is really helping people, educating people, helping them realize things, how they can do better. I want the best for everyone I meet and anyone I can help in any way. And if people don't want my help, that's fine too. But I just really want the best for everybody. So, everything we've talked about tonight, I know I went through things kind of quickly. I just wanted to give you a brief overhaul. Again, you'll get a phone call from Jackie or myself if you haven't already emailed me to set up your own one-on-one to so I can kind of help you with your own individual situation or any questions you jotted down tonight. But everyone's map is differently. There's no cookie cutter plan for everyone. Every one of us is very unique, and we all have different situations and different needs, and we all have different amounts of savings of what we've done with our lives. So everything has to be kind of custom built towards you. Like I said before, this quote kind of sums it up, but I really want everyone to pay their fair share of taxes. I'm not interested in skimping the government out on any kind of penny at all, but I want everyone to pay attention to the tax codes and do everything as smartly and as efficiently as possible. You can't get back $1 you pay in taxes. And $1 saved is worth more than $1 earned, because $1 earned you still have to pay income taxes on. But $1 saved, you get to determine how taxes get paid on any kind of profit you make on that. So that's really up to you. So it really is up to you. I advise all of you to plan and kind of get ready for your own future. I know that's why you're here tonight. My office, we also do classes and give advice on Social Security. Most of all, thank you for coming tonight. I want everyone to stay safe, be smart about what's going on. I know this is an unprecedented time. We're all in this together. I'm so proud of my fellow Rhode Islanders. It seems like we've really been doing a great job of social distancing. Whenever I go to the store, which is not very often other than the grocery shop, I see everyone wearing a mask, everyone really kind of looking out for each other. That really warms my heart. I do everything I can do. I'm not a doctor, but this is how I try to help people. And that's really what it's all about more than ever. I think a lot of people are realizing that and how we're so connected. So be safe. You'll be getting a call from Jackie or myself so we can set up a follow-up. Thank you again for coming tonight, and I wish you all the best. I'm going to put one more time on the screen there an offer for you to, click and email me, telling me that you're interested in setting up an appointment so we can maybe look at your situation and help you out. Right now, my office, because of the COVID, what's going on right now, we're not even charging people planning fees at all right now. So it's kind of a unique opportunity for you to get some free help with everything. So take care of yourself. I'm signing off. Go eat your dinner if you haven't already. And I'll talk to you. Maybe you'll hear from either me or Jackie soon. Take care.